Okay, everybody, thank you very much. Man, that news trader looks pretty awesome. Let me tell you that. Um, there is one of the trades that I actually like is called a retail trap, and it's very similar. It's basically fading news um, and getting involved in explosive, but unfortunately, there's a lot of risk involved in doing that, and so I do. If you have an explosive move outside of an area, specifically on a news event, I can suggest that you fade the initial move, and then you have an opportunity to do a retracement trade, and then you're able to actually go in the main direction of the advertised move, and you get the bulk of the trade. So there are great ways to trade news. But in general, I guess I would say that I stay away from open and closes of the markets, bottom of the hours, top of the hours, because what happens usually is you get, a little bit of slippage. Yeah, that does occur, and you get into a trade, then you see yourself get ticked out just before it goes in the direction that you have already anticipated. So there are ways to actually, the majority of trading is really going to be based upon your understanding and concepts of the market. So yes, I can talk about Nadex for sure, and that is definitely a way to trade the news without getting ticked out or getting spiked out. And in general, it's a great way to trade on a daily, an hourly, and a weekly basis. But with trading, as in anything, this happens to be the Nadex platform right here. It doesn't matter what the instrument is or what market you're trading, as long as you understand the playing field, right? So just like at any professional level, on anything you do, golf, football, basketball, even chess, checkers, or trading, you have to know the rules of the game. And one of the things I'd like to discuss before I actually go into taking a look at the markets and maybe finding something if there's something to do overnight, or at least giving you some levels to trade for the next day, let's go ahead and let's just take a step back for a moment, if you don't mind. I want to, I've been developing my notes over the years, and this comes from an extensive background in both the buy side and the sell side of the business. I was involved since about 1994, and I worked for a private equity venture capital firm, and I was an analyst. That was really my first job at a school, and it was my job to analyze M&A deals for the firm. So I was director of acquisitions, and that company lost funding. There was actually a recession back in those days, 94, 95. And there was one of the market crashes, big market crashes that shut down the exchange was in that year as well. So was it 95, 96, 97? Forget that. There's been so many crashes these days. It's hard to keep track. But the concepts of everything you're going to do is really going to be based upon, again, one of my favorite movies is The Matrix. And I want to play this. It's called The Construct. And it's basically an eye-opening moment. And what I want to do, though, is I want to start with basically a blank slate. And in the beginning, in the very beginning, it's not going to feel real. It's going to be unbelievable. But if I can simplify it down to the common basics of what makes a market, and it's called auction market value theory. So auction, the buys and the sales, right? There's going to be traders in there that are more aggressive and less aggressive. And there's going to be areas in the markets where are they going to be more aggressive? So in the beginning, it's not going to seem real because what's mostly taught out there is a fancy indicator, a fancy, something that has a moving average, or it's an indicator that's based upon what I call the C factor. So there's actually, underlining the entire markets, there's an A, there's a B, and there's a C. C is normally what is a result of A and B there. And we address the A and B component of the markets, and so break it down into its main components. Then we can have an understanding what C represents. And then that understanding is you are able to anticipate something to occur, and you're able to confirm that based upon the actual what's called order flow. And this order flow is simply a recording of all the buys that occurred, all the sells that occurred, and basically keep track of it. So in the end, what I want you to understand is we are trading a very complex system. All of these markets are very complex. And one of the very important understandings is not only do you have to know yourself, but you also have to know your competition. And you have to know exactly what it is that they do and what it is that they're there for. Okay. Can you guys hear me still okay? So one of the things in my journey, let's say, is yeah, okay, excellent. You guys can see it? All right. So my journey through trading, obviously, it's extensive. It's been on both sides. I had the opportunity to trade at some of the larger firms on Wall Street, and had opportunities to trade as an institutional trader. And then I also thought that everything that I knew about the markets, that it would translate into trading, what's called retail trading, what we're doing now, right? What everyone here is doing. And in the very beginning, I went through a very, very, I failed miserably, even though I had almost 15 plus years of experience on Wall Street and knew exactly the ins and outs of the Wall Street. I was one of the guys that actually the traders on the floor came to. Hey, Kai, what's going on? What do you see? And it's just a whole different animal. Now, because I don't have now the access to the technology, the access to the capital that I once had, I have to understand my competition, understand my strengths and my weaknesses. Our strengths and weaknesses, there's two parts to this. A strength that we have is that we don't have to anticipate a trade and take a trade all the time. That's not our job. What our job really is to do is to anticipate something to occur, and then we wait for the confirmation for that to occur, and then we only take a trade when that happens. And that's part of what's called homework. So what I learned over the years is that trading, intraday trading, the majority of it is actually the homework that you do the previous evening, leading up to the opening day. And now that I think about it more and more, and I relate it to what I used to do, it's a very similar situation. I didn't just come in to the office and start trading. If I had a multi-million share buyback for a corporation, or I was selling or distributing for a hedge fund, I didn't just sell those at any spot. What I had is I literally had a level or a range. And then what happens with that range is I'm simply trying to get as much done as I can. But then what I do is I try to better my average so that I can report back a better print to the client, and in result, get more of their business. Everybody follow me? So I've come across things that help. And what I want to do is start with a blank slate with you guys. So first we're going to talk about what markets should you be trading. I'm going to assume, or can I assume, that the majority of you in here, let's just say 80%, 80% are probably trading with less than $10,000 in your account. Can I also assume that perhaps the majority of it have probably 5 years or less of trading? And can I also assume that maybe 90% of you probably never worked on a professional capacity within this business? But yet somehow, whatever you've done in your past, you believe you have what it takes to be a successful trader. Now, whether it was a bill of goods sold or it was, a 90s bull market that helped, that all you had to do was buy retracements onto a moving average and just buy and hold, or maybe you started with a small account and you had a couple great trades right away, but then and now ever since you're thinking like, okay, why can't I make this happen? I've made money before. If that sounds like you, or because that happened to me as well, I'm telling you that you're looking at the markets all wrong. So one of the things that is better to understand is the playing field. Now the playing field, and I'm talking about the futures markets mainly, but also, futures on Forex and also the equities markets. I'm not really talking about mutual funds, but in general, any market that has a buy and a sell as well as volume reported. Okay, so what I have here is something called, it's the market profile concepts, and it's funny how with all the technologies that we now have, with all we're kind of on a similar playing field or a level playing field to the institutions. We now just have to understand how to play the game. So in my opinion, in my experience, it's always been about following the big money. I've always been one like, okay, if they have more money than me, if they're smarter than me, then maybe they're doing something right, or maybe they've done something right in their past, and I should probably learn from them. So right here it says here, stop trading like a retail trader. Trade like an institutional trader. And it says here, did you know that both groups do the exact opposite? Retail, us, we trade price and we use technical analysis. Technical analysis is the C part of the equation of A and B. So therefore, there's lag, okay? There's latency, there's lag. And they also, or retail, also buys high, buying breakouts, and they sell low. They sell breakdowns, double bottoms, triple bottoms, right? Institutions buy as the market moves higher. I'm sorry, they buy as the market moves lower, and they sell or distribute shares as the market moves higher, because they're bettering their average. They're able to get most of the business out of the way, but then they can better their average. And it's kind of measured by this thing called a VWAP, volume weighted average price. But they also anticipate the levels that they're going to do business at. But they have this technology, this access, that shows them exactly where the orders are on the book. Whether it used to be the specialists on the floors, and they had the New York Stock Exchange book, and many of the firms had the book, or they have the Bloomberg access, the trade book. These are just, these are usually expenses that are far outside of our realm, on a retail perspective. So if you like, I can offer, I didn't put together any offers or anything, maybe I should have, but if you'd like to go to Redbridge Capital Consulting, that's the name of my company, and you want to send me an email, click the email, I'll send you this. It's a 346-page workbook. Now, this is a workbook with everything you need to learn about how to trade like an institution. And this is the actual copy of the workbook manual that the Chicago Board of Options Exchange trained their traders, their professional traders on back in the 80s. So the funny thing is, with all this technology and access, it's all about going back with what works. And what works is reading order flow in the markets, where a level of buyers and sellers got together and agreed upon a price, where the sellers were more aggressive and they took over and that market went down, or where after they found a balanced market that the buyers took over. And make note of that in your references, in your homework. And once you can understand this, that it really comes down to something very similar. And I want to show you exactly what I mean through a couple of charts. Okay, I'm going to pull up just a regular chart. I'm going to pull up a candlestick chart. And I'm just going to pull it up of a very, very simple crude contract. Okay. Now, is there anyone here in the room today who was with me on Tuesday morning in the Global Trade Room? The Global Trade Room is a trading group that's headed by a CTA, and we educate traders on basically order flow and executions and how to mitigate their risk and how to confirm their executions with the tape or with the bid and ask. Is there anyone in here that we do a free trial on Tuesday mornings with the Global Trade Room? Okay, well, what I want to do, yes, okay, great. So what I want to note is I want to go back a few days to Tuesday. And I want you to understand that if you go back in time, it's all you have to do. Okay, Tuesday was the 6th. Yes, Tuesday. Okay. There was an opportunity to, and I called this out live in the room, and if there's anyone in here that was there, and you guys can confirm that, that would be great. But it was a long on the crude market from 99.81 to 130. Okay? And it occurred at 10 o'clock, around the 10, here we go. Okay, right here. Now, all I'm trying to prove is not that this was a great trade or anything. I just want to point this trade out because there's proof that it was called live in front of, there was actually 226 people in the free trial that day. So over 226 people were able to witness this. And it's not magic or voodoo. I'm not pulling any wool over your eyes. This is just once you understand the concepts of the markets. Everybody with me so far? All I'm saying is before you go out and you spend your next dollar on any indicator, spend that dollar on educating yourself about the markets. And that piece that I just showed you, that market profile, that piece is free. That's free education. Now, it's not in a glossy book that's been advertised. It's not a beautiful glossy book. It's dry and it's dull, right? And it's something that's been passed among traders on desks and such for the last 20, 30 years. But it comes down to things that even Jesse Livermore back in the, when he was a teenager in the 19th century, early 1900s. Early 1900s. So all I was looking for is taking basically a chart like this, and I can see that if you can understand this one thing, when a market goes into a trading range, okay, as such, right? Anybody can do that, right? Any of you guys. Then it goes into another trading range, okay? Then it goes into another trading range. right? So what is occurring is there's actually buyers and sellers trading around this range that is about here and here. Let's just call it 99.53 to 99.64. So based upon what's called an auction market, what this means when a market goes sideways over time and price, it means that it's creating value, or it's pretty much a fair price. So this is a range. So again, this is going to talk about how I'm given an order, I'm selling 3 million shares on that day, but I'm limited to a range that's told to me by the customer. And then in addition to, of course, I want to get paid. I want to sell as much or buy as much as I can because I get paid on volume as an institutional trader. But I can only, because I don't want to show that I have actually 3 million shares to do, I only want to show 50,000, 100,000 at a time. And it's almost like playing cards. You even play cards with the same specialists that are running that market, or the market makers. Okay. So what happens is I piece out a little bit here and here, and then all of a sudden there's an opportunity where the market gives better prices. And so what I do is I get most of my business out here where it's fair prices. Basically, the buyers and sellers are equal. That's what happens in an auction market, is it stalls. And then when an auctioneer for like classic cars or fine wine or fine art, what do they do to get a higher bid when something stalls? They advertise. They add adjectives. This is a one of a kind. This is Thomas Jefferson's wine, or this is only 20 made of this classic car, and it's perfectly restored. It's never seen the road before, right? That's what would auction the market higher. So if a market finds balance and it's efficient, then it auctions outside of this area, it shortly becomes inefficient. And what happens is prices become left behind because this happens rapidly, and these prices can be recorded these days with this kind of technology that we have these days, okay? Then what it'll do, it'll settle and trade around, create a fair level, and then auction back. Now, what if I told you that the only thing that a market does is this? It will trade from balance to imbalance to balance to imbalance to balance. That's it. That's all it does. All day long, that's its job. Its job is to stay in business. Its job is to bring as many buyers and sellers together as it can, because it gets the membership fees, and it also gets exchange fees. So it's in the business of volume, creating volume. So it's going to explore what's called value, because value is where most of the volume lies. Okay? Less volume through here because less time spent with these prices, they run away. More volume through here because it's time spent over time. Kind of rotates around, right? A number. So if that's all that you need to worry about, very simply, you could start to just identify, just like I did here, previous levels of acceptance and rejection. So I just went back to, what day did I go back to on that? Let's just say it's the previous day. Let's say it was Monday. And notice how now it's kind of, I can actually extend this all the way out, and it still has an effect on the price, right? So knowing that the market is searching for value, and it searches for value through price, I can find these levels, and these levels become important. These levels are where you can anticipate something to occur in the future. Okay? So I'm not using any kind of, this is just a drawing tool I'm using, a box. But understand, I'm talking about the concepts of the market. Can I pause for a moment and make sure that everybody's with me so far? Does everybody understand why I'm going through this? Okay. So you don't have to become predictive in nature. You don't have to be on the seat of your pants. All you have to do is be patient. And one of our best traders told us, you are paid to wait. That's what you're paid for. You wait for the level. Then when the level comes in, then you look at the order flow, the bids and the asks, and how aggressive they're getting. Then you take a trade if it's only acceptable within your risk tolerance. If it's not acceptable within your risk tolerance, I don't care if your risk tolerance is 15 ticks or 20 ticks, or 10 ticks or only 5 ticks. If it doesn't, if that trade setup in your anticipated area comes in, and let's say you can only risk 5 ticks, and it's set up at 8 or 10 ticks, well, what do? Pass. You just pass. Okay, you're paid to wait for the next trade, and you're almost waiting for a pitch, a baseball analogy. You're waiting for a pitch within your wheelhouse, within your comfort zone, and a professional baseball player won't swing at every single thing that's pitched to them, right? What they'll do is they'll simply wait for the pitch that they know they have a high probability. Now, the probability of them hitting a home run on that, they don't need that. On-base average is actually more important than hitting home runs. So if you can also think of this as a business, don't step up to the plate every time and think you're going to hit a home run, or you're going to crank the driver 300 yards every single time you step up, and it's going to be perfect down the fairway. There will be that opportunity if you address the fundamentals of that swing and that setup. So as we're coming in, let me go back to that date. It was the 6th, 5th, and 6th. Okay. So as we're coming up to this level, okay, now what? If I look left, I can also note that, notice these areas here where it went back and forth? Well, look at that. The reason why it's pausing now is because previous buyers and sellers, in this case sellers, took over after the fair price. So I can create a level, and this level comes out at 99.80. Can everybody see that? Can everyone see 99.80? Okay? Now, look back again. You see this downdraft here, where time spent very little, where price spent very little time and it rapidly moved? Everybody see this area right here? So imagine price does not have enough time to stay at each price, so there's not enough time to accumulate volume. So this becomes an inefficient market. Everybody follow me? But previous to that, there was an area here. So this area here at 100, starting at 109 up to about 120, and as a matter of fact, it was actually 130. That was the call to. So as we came up to this price of 99.80, and again, I'd called this live at 99.81, and I wanted to see it up to 130. Let's look at this. We go up to 99.81, and then quickly, see how quick that goes? See how quick it went right up to this level? And then it goes to 130, and then guess what? It settles in at that price. No voodoo, no magic. The understanding of the market is key, and what is there for. I'd like to pause for some questions. You guys have any? I want to make this one interactive. Usually I just go off on a tangent, if you guys have heard me before. So can I ask you something? Any of you guys think you can do this? Five pips. No, it's, so in crude, this is a tick. Each, okay, so 80 to 81 is $10. 81 to 82 is another $10, so $20. So this went from 81 all the way up to 30. So 20 ticks to 100. 20 times 10 is 200. Another 30 ticks, 300. $500 per contract. So one contract in crude, you'd leverage, you're controlling, basically your margin is 1,000. Yes, there you go. So the risk was very minimal because the stop was actually, there it goes. From 81, it was right back in here at about 76. It was really, what did I call it at, by the way? You guys, any of you in here remember what I called the stop? Well, let's put it this way. The risk was actually 4 ticks because that's what I have my strategy set at. It's 4 ticks. So 4 ticks is times 10 is $40 per contract. So $40 to make a little bit of money, right? Okay. So, and that's where it comes now. What I'd like to do is I want to show you that you see this 130 note or this 100. Notice how where at 130, notice where it hit multiple times. Rejected, came up, reject, came up, reject, came up, reject. You guys notice that? Let's mark off 130. Okay? Now, let's go forward in the future and let's see how many times 130 comes up. So I know it came up yesterday and I know it came up today. So let's take a look how it interacted. Look at that. Okay, next day it interacted to the tick. Now I'm not promising you that you're going to be able to trade to the tick like this. I'm not promising you that. But what I am promising you is that if you can identify this well in advance, and then when the market comes up to this, you actually look at the order flow, the bid and the ask, and you see if there's any aggressive. If you're looking to go long, you obviously want to see aggressive buyers accumulating through here and going to push it through and continue through, right? If you're looking for sellers, well, you don't. If you want looking to fade this level, well, you obviously don't want to see a bunch of buyers, do you? You want to see sellers, right? And the most important, and remember I mentioned, it's probably better it's probably better to follow the institutional order flow and sellers. They've got the money, they've got the capital, they've got the access. They actually know value better than anyone. And by the way, the beauty about the futures markets is 2 things. The futures markets were created to be 100% transparent, meaning all of this information is available for those that can look and understand the concepts of the market, just like in the Matrix movie, The Construct. So if you can understand the concepts of this, you can see what's really going on in the markets. So let's go ahead and let's continue to look at 130, because I'll show you another trade that I took off of 130, by the way. Okay, now we broke through, right? So if this didn't show, if this spot here did not show a benefit to you, then you didn't take it, right? But you know that this breakthrough, if buyers really showed themselves, and what is, remember a market is called balance to imbalance? Remember this? balancing to imbalance, balance to imbalance. That's all that it does, right? So what if we could measure imbalance, trade imbalance? Well, I've created something that will actually measure this trade imbalance. So what does that mean? Okay, so if I trade 3 contracts, 5 contracts, all of us collectively together would amount to next to nothing compared to what's available out there. So I don't want to know what you and I and collectively what we're doing, putting our 1s and 2s and 3s and 5 lots in, right? I want to know what are those that know what value is. And value, because it's 100% transparent, these are called commercial traders. Commercial traders are the ones that even the pit traders follow. And what happens is they will come in with an order because they have an order from their big client. Maybe it's UPS, maybe it's United Airlines for crude markets example, and they're buying for the entire fleet. They're buying for the season. They're hedging a large position. Okay, so you want to know what they're doing. Now, here 130 becomes. Look at now. That's not to the tick. Again, I didn't promise it would occur to the tick. But 1, 2, okay, 2 ticks. 2 ticks. And it hits again, 130 by 1, 2 ticks, right? Now it becomes, what is it doing now? It's rotating around that, I cheated. It's rotating around that 130, right? So what it's doing is the market is actually finding value at 130. So remember, so after a market goes into balance, what is its job? The market's job is to find value. How does it find value? Through price. It advertises price. So let's take the previous levels of value. Now, as we come outside of this balance, oh shoot, what? Are you kidding me? It just went down to the bottom value of this box I just drew. Oh, look at that. Why did it range? It was finding, it was finding value. Value within value, and that value was determined because of this information here. Now, where is it going to go? Back to value. We're here. Now, that's not the only time that we're going to visit that 130 that I called live on Tuesday in front of 226 people. It's a 99.81 long to 130. So where are we today? Let's take a look. Okay, forget about everything that's happening up there. Let's come back down to, okay, notice how even though this market sliced through that 130, notice how it reacted at that level. Reacted, sets itself up for another opportunity back to 130. Notice how it rotates around. Notice how it's still reacting. This is 3 days later, you guys. This is today. Look at that. Now it's pretty much, this is current market, 130. Was that magic? I only picked the price because I had 226 witnesses. When I called it on Tuesday, that's all. I didn't just cherry pick it, I promise. But I understand how the market works. Now that I have an understanding of the market, now that you have an understanding of the market, I would pause. Let me pause here. Let me take some questions. Someone says spellbound, no questions. I promise it's not spelunk, it's not magic, it's not. Has anyone taught you this before? Has anyone heard this before? I know if you've heard me, I teach it every single day. Okay, for those that have not heard it before, is there any question you could possibly come up with that I can help answer? Why? Okay. Why does outside price move so fast to the next value? Okay. Because it wants to, is what you were teaching in that book. Uh, yeah, yes and no. Yeah, sure. Why not? Yes, it is. It is. Okay, it's called, so what I want you guys to do, and this is, let me come into this little document that I've been creating for my group. Okay, this little document I've been creating. I talk about the assumptions of the market and a few questions that a great trader should always be asking themselves. Let me go down to, these really are just notes. So I want to tell you guys that I'm not making any of this up. I've learned this from just obviously being involved. It's almost in depth. Okay, you are okay. Let me just answer these questions. Question: why does outside value move so fast to the next value area? Because there is a difference between. There's a difference between. Here's my famous drawings that I do. Value and value and value. And the difference between here and this is what happens, this is called a volume profile. So we see, and maybe you've heard volume leads to price, but if you haven't heard that, search it. Maybe it'll come up. But remember, this is time. This is only time. This is price, and this is volume. On the side, right-hand side, left-hand side, if price spends time, it's going to have volume, a volume profile. And this is a 17th century. This is a 17th century mathematician that discovered the standard deviations. And this standard deviations happens to be a regression to mean. And this standard deviation, the concept, which is Stats 101, it's called K, level K. And this, imagine there is enclosed, the example that I remember in school is there's an enclosed farm and there are two rabbits. And then they have lots and lots of carrots. And that rabbits do as they do, is they multiply and multiply and multiply and multiply, and they eat more resources, right? Well, they get to a balance, a harmony. And over time, they flourish. Then what happens is they actually move outside of that balance, and a regression to mean brings them right back down because they actually run out of resources and they come back to a balance. Then they balance and balance and balance. Then they try again, but they're less and less this time, and now they actually start to die off. And then there's no rabbits left. And so in between these levels where value and value lies, let's call it a dead zone. That dead zone is there's no agreement on price in this dead zone. It spent very little time, and that is the reason why price can rapidly move down, because again, it's searching for value. Remember, the markets they open and they close, and every single day they want to stay in business. So every single moment they're looking for value as fast as they can. Now, next, support and resistance. Okay. support and resistance. Let me just show you a chart I have already marked up. Support and resistance. What is support and resistance? What is it? Resistance is previous collectively. Now, if at this previous level of sellers, let me just mark it off right here, here and here. If this previous level of sell balanced and balanced, but then who took over? Sellers. Now, who can move a market outside of balance? Who can create trade imbalance? Who can trade 300%, 400% over the asking, or over the ask, or the buyers? Institutions. So it's important to reference and identify where those institutions are. Because when you do, you'll have that 130 mark. And you'll have that level in the future. These are previous sellers. This becomes resistance. Then you come up to that previous level of resistance at some point, and it reacts. That is supply. This will occur almost indefinitely. Okay, there it goes again. So every time it gets up to this opportunity, you have to know that it was previous sellers. Is there a characteristic that is associated with a quick reactive to the mean? Yes, there is actually. Okay, that's a very good question. Here we go. I'm just gonna show you or teach you what is written out there. Let me just go through. Okay, see that there's a price versus value here. Now, perhaps it says here, perhaps the most important skill you must master to become a successful trader is the ability to distinguish price from value. Aha! Light bulb, love it. Let me see more light bulbs come up, go off, please. How many light bulbs are being? Absolutely. So, this was from Markets and Profile, Jim Dalton. It's a book. I just took the quote from the book. And what happens at each one of these levels is called, I'm sorry, close your eyes. Let me get to this. I don't want to make you dizzy. Okay, here we go. Let me, again, this is just notes from a book, a good book, right? The good book. Price exhaustion. Trends end in either of two ways of a combination of the two. The first occurs when volume, which is in the direction of the trend, simply dries up, as if the participants that were driving the directional move are all left. So participate, and it creates an excess low. So if you can actually look at the orders that are coming through, you will literally see them start to die off. They'll get less and less and less sequentially in order. 3 or 4 prices in advance. They'll start to put on their brakes. And it's just like physics. You have to apply friction. So in order to apply the brakes to a train, you got to start pumping the brakes. It's not going to just stop on a dime. So it starts creating that friction. And what does this do? This opportunity, the ending of an auction, which actually is complete when all prices, all buyers and sellers have fulfilled what they wanted to do at that order. And it actually shows in the order charts by basically going like 0 by 5 or 5 by 0 versus 5 by 50 or 50 by 100. So it completes. The auction is complete, and now the market can pivot and turn. And the ending of an auction offers the moment of greatest opportunity, as well as the moment of greatest risk. Well, we teach in the Global Trade Room how to mitigate that risk down to 4 ticks or less. in any instrument moment to do is, let me see, I think I might be able to type this in. Go to globaltraderoom.com and watch us do this live tomorrow morning. I don't know if that type, there you go, there. Go to here on the very first page. Go down where it says Trade-a-thon. Click right here. For tomorrow morning at 8 a.m. from 8 to 12:30, Simon is a licensed CTA, an advisor. And we can literally show his exact entries and exits. We can call them out, and you'll see this is not simulation. You know, see the madness. Trust me, there is a method to the madness, and that's what we teach. So go to globaltraderoom.com, very first page, scroll down, and there we are. Okay? So I'm going to pause on this. I'd like to address again the markets that you should be trading. I'd like to talk to you about a couple things. How many people in here trade the S&P? E-mini S&P. Now, how many of you are trading with at least six-figure accounts, seven-figure accounts? Okay, I'm going to go back to the 80%. I bet you 80% of you are not trading with six, seven-figure accounts. So my suggestion is to trade an instrument that's created for you. And there is an actual exchange. So you know the E-mini trades on the CME, right? Now, there's an exchange called the North American Derivatives Exchange that can also trade the E-mini for you. And it can trade you based on a daily and a weekly. 7 cents. 7 cents? Sorry? Well, okay, it's okay. I'm counting decimal. Sorry. Let me go on. So the S&P 500. And this is saying that there's markets in the S&P 500 that will trade between these levels, 1870 and 1910, 1850 and 1890, 1830 and 1870, 1830 and 1910. Okay? Let me just, because I have this up, well, I don't have a chart. I closed down a lot of my charts just in case, you know, I've had some problems before when automobile crashed on me. So just because I did that work on the crude chart, let's go to the crude, okay? Let's go to crude markets. So go to commodities, go to crude, and I see that there's a daily range between 95 and 105, 95 and 100, 97.50, et cetera, et cetera. So let me just let me look at my crude chart again. Sorry, let me move this out of the way. Can everybody remember that number that has been trading around? Everybody remember? Just remember. So let's look at it. We are currently, obviously, in a dead market, but we're still ranging around these areas. Now, why are we ranging around these areas? Because previous areas, right? And see how it's kind of showing up in volume on this right-hand side? That's just volume at price, okay? Well, what's ahead of us? Okay, look, I have this up here, a little bit of volume, up to 150. There happens to be a little bit of a volume, and then if I can get through 150, there's an opportunity all the way up to here, 160. Then on the downside, let's check the downside as well. Okay, down here, I have basically trading around, up to about here, 104, about 100. So I have levels now, don't I? And this is called market-generated information. This is not lagging, it's predictive. Because again, I'm addressing A and B and not C. So I'm trading price versus value. Is everybody with me on that? That is so huge, that's worth its weight in gold. So now all that I have to do is when those rabbits start multiplying and multiplying and eating up all the resources, and then they get excited and they break out. Well, what do I need to do? Trade the price. Trade price that it's going to come back down into and start to die off. It's going to rinse and repeat. Yes, rinse and repeat. So I'm having levels. I've created levels based upon what's called market-generated information. And when buyers and sellers get together and an imbalance is created and an auction is finished, they're going to trade it right back to find value again. So I have a level of value of 130. I have a value at 150. I have a value at 163. And I have a value at 108. So let's take a look at this real quick and see if we can't find something to do right now. So I have here a range between 95 and 105. By the way, the NADEX is a contract. It's an agreement. And you become a member for as little as $100. So to put up is simply your risk. So let's say you risk $40 in the trade. That's all that you have to put up is $40. And the other side of the trade is taken and agreed upon. And so if you win, you win 60. If you lose, you win 40. Okay? And that's all that you lose. So if you can afford to lose 40, well, maybe you could do 5 contracts. If you can lose 200, then you could obviously make more than that on the top side. So there's a win ratio. So let's go 95 to 100 of 5. So I have 95. Let me create this real quick. I'm going to draw each of these levels. Okay, I'm going to draw each of these markets that I'm interested in trading. 95 to 105. Wow, that's way down there. Okay, 95 to 105. That's probably not even realistic, but it starts at 105. That's a big market. Let's go ahead and that's just for 95 to 100. Okay, here's 100 down to 95. No, I don't think we're in that position. 97 to 102. So the top basically is 102. And the bottom is 97.50. That's a big range too, isn't it? I mean, yes, I know the market, crude can run that, but holy moly. Okay, next one, 100 to 105. 100 to 105. Oh, hey, look at that. Okay, hold on a minute. Now I know we're not going to 105. But that 130 has been involved for quite a bit, right? So let's take a look at that market. There's an order ticket. So what I'm saying, the underlying market is 139. It's 142 by 152. Let me just show you if I were to buy one contract at 42. My maximum loss is 42 because my floor is set at 100. So if the market did go down to $95 before tomorrow at 2:30, wait, the 9th, yeah, tomorrow. By tomorrow at 2:30, I would only lose a maximum of 42. But if I was right, I could make a maximum of 458. Now all that I have to do is put up $42 per contract. That's all because there's a floor and a ceiling. I can't make more than 105, and I can't make less than 100. So I am in a decent level to go long, aren't I? Let's go ahead and put on. What do you think? Now, what happens here is if every tick up is going to be $10 until it reaches 1,374, and I'm risking 126. My downside is 100. I have all the way until 2:30 tomorrow for it to trade up towards 148, 150, and most likely back up here to 177. If I'm wrong, I can get out at any time there's a clean market. I'm going to go ahead and put that trade. Order received. I'll do 3 contracts now, and then I'll go ahead and I'll take a look at tomorrow. I can take a look at that market tomorrow, and we'll see what happens. But just remember 130, and remember 100 and what was the top? 105. I can't lose anything less than 100. I can't make anything more than 105, and that's my. I have 17 hours, and 10 minutes. If you'd like to learn more about this product, you want to go to nadex.com. And first of all, again, don't worry about a product. Worry about understanding the markets first. If you can understand the basics of the markets, then you can trade anything you want. And then you want to trade something that is meant for you. The markets, the futures markets, the S&Ps, you've all heard of the flash crashes and the HFTs and the algorithms. Well, do you know that the S&P, even though the product now, but that runs greater than 62% of the daily volume is program related. No hands touch it. They simply program it. The beautiful thing is that there's laws. There's laws to programming. And most of those laws are mathematical laws that cannot be escaped. So if you understand the concepts of the market that I'm talking to you about, you can also beat the HFTs in the markets. So yes, there's speeds and there's fastest to the exchange and low latency and yes, okay, if you're trading along those ways, yeah, I guess you could think that it's rigged, but not just trading value to value versus price. And we're waiting for something to trade when it shows up, and we can take the trade based upon our risk. So if you are interested in Nadex, there's 2 things you can do. On Tuesday, this is not up yet. So I will get this updated for next Tuesday, but just go to globaltraderoom.com. globaltraderoom.com. I'm typing it in right now. There you go. Scroll down to the Trade-a-thon. Join us 8 a.m. tomorrow. Then on Tuesday, next Tuesday is what? What's next Tuesday? Next Tuesday is the 12th. No, 13th. So Tuesday the 13th, we're going to have 2 of the representatives of the exchange come by and do an in-depth teach-in. One's basically marketing and sales and strategy. The other is basically technical, not for the institutions. Because 62% of the money being traded or shares being traded on S&P are program related, and who do you think writes the programs? The institutions. So it's very, very hard for us to do very well in the S&P because, well, let's just put it this way: it's very efficient, and they really, because it's cap weighted, they really only have to manipulate about 6 stocks to control the entire 500. If you do want to trade a better market or better index, may I suggest something like the Russell? The Dow is basically 2 stocks, 3 of the highest price stocks, and the NASDAQ is also market weighted. So you're talking about 6 stocks as well. But the Russell, take a look at the underlining, what makes up the Russell. There's not one of them that's over 0.5% weighting. And so basically it's an equally weighted index. So guess what that means? Institutions can't manipulate it. If they were to manipulate the Russell, they'd have to manipulate all 2,000 stocks versus 6. And why can't an institution manipulate all 2,000? Because the volume traded within those stocks are too small for the institutions. Whereas the volume in Exxon and Apple and whoever else, the volume is so large that they can very easily hide and do their ice. The Russell gives you a lot of opportunities, and when it comes into your anticipated level, your homework level, you can get a reward very, very quickly. Or you know right away that you're wrong, and you can mitigate your risk down to 4 ticks. 4 ticks is $40 per contract, using a future, by the way. So I just suggest that you take a look into the Russell and look into trading something that's more suited to you. And if you don't have, $10,000 in your accounts, start with something like the Nadex and get a feel for what value and price is. So the beautiful thing about the Nadex is trade value. All I did was put on a trade there, and it's based upon value. That's all, not price. So I can't get ticked out of there on a news event. Gosh, is that frustrating. So I obviously, I'm getting pretty good at this. I do private mentoring. Let me stop with, or let me finish with, where's my website? All right, let's just go. I'll just pull it up. I'm going to do a couple things here. I want to share with you, it's obviously, I can sit here with all my experience and everything and say, well, you know what, trade like me. Well, the thing is, you probably never trade like me. But if I can teach others to trade and then be able to see and understand the markets, if I've ever traded, then therefore I've done my job, right? Yes, that's right. Only U.S. residents. I apologize. Nadex is for only U.S. residents. Now, Redbridge Capital Consulting. I'll put it in the. You can go to here. This is my personal website, and I do private mentoring through this. What is it? Redbridge Capital, as it sounds, consulting.com. Okay. Now, if you go there, you can go to what's called the construct. Click on the construct and send me an email by clicking here. Send me an email that you want the manual, the market profile manual, MP manual. It's one of the most invaluable pieces I have ever come across, and guess what? It's free. That's the beauty about it. Now, as I said, it's dry, so, but I want to finish off with folks that I'm teaching that understand these markets now to a point where even I am just in awe of their accuracy, and it's beautiful. Because let me show you a trader who did a quick snapshot. Now, this is not me, okay? This is not me. Now, what I'll do, now this is something I developed. It's called the Ninja Order Flow Sequence Tracker, and what it does is it's going to track the institutional trade imbalances and block trades, follow the money kind of thing. But for whatever reason, his homework lined up to where he had a trade at 61. He's got 3 contracts. This is the crude markets, okay? I want you to know that it went 3 ticks away from him on 3 contracts. Now that is $90, right? So it's only 5 minutes, but we have that time. I want you to notice the accuracy of his move. Okay, it went $90 in negative, then it went $60 in negative, then it went $30 negative, then it went flat, negative 30, then it went flat, then it went positive 30. Okay. Flat. So I've taught him to read these numbers and these levels. That's all. And he's not the only one. So I know that others can do it. It's not just me anymore that can do this. I did this all by hand before I spent the last year with a programmer designing this. To include everything that I used to do by hand. Now, yeah, these are called bid and ask charts. But what it's doing that's different is it's showing me trade imbalance. So there's the trade imbalance occurs when there's something like 2.5, 300% over. And then it's showing me unfinished business versus a closed auction. Then it's, okay, so he's got $100. Oh, it looks like he took a contract off. But remember, it went $90 against him. 90. And it didn't go, that's 3 ticks. 3 ticks. So understanding the markets and being able to read what the institutions are doing and just simply follow their footprint, you can take trades with very good accuracy. And I'm glad that he shared this with me just the other day, because it's better for me to show you a student that's doing this versus me. This ends up taking out 170. Let's just take a look. I think it comes all the way back. Yep, it comes all the way back down, but I share with him where to hide his stop. And his stop is hidden at 160. So it comes all the way back down to flat. And then it doesn't take him out. And then it goes up, 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 up. Come on, go up. Now he moves to the break-even +1, and he gets another off. So the importance of knowing how the market works and knowing where to put your stops is pretty important. Okay, so that's just one. I'd like to, I ran out of time. I was going to show you, I've got charts, snapshots. I asked for the traders to take snapshots for me of their trades. Here's another trade. Here's another, 42 ticks is $420. You know, he's identifying homework levels. I know it looks like a mess, you know, whatever. Here's just some more. 23 ticks on 5 contracts. Just trading, you know, 23 tricks is, you know, 10 a.m. tomorrow morning, 8 a.m. That's it for me, you guys. I appreciate you being there for me. Hopefully you learned something, at least an eye-opener. I could finish with that Matrix movie if you want. Finish with the